Good day, everyone, and welcome to this update on Balance Advantage Fund. Over the next few minutes, we'll discuss the fund strategy and also take a recap of the last 1 month. Markets, as you know, have been volatile in the last few months, and June 2025 was no different. June saw some events like Middle East conflict, which led to oil price volatility, while we are nearing to this 90-day deadline for the US tariff negotiations. RBI to cut the rate by around 50 basis points, taking overall reduction to around 100 bips in the current rate cut cycle. In the midst of this, if you look at broader indices, they were up anywhere between 3 to 7%. Now, if you look at the returns, studies do suggest that asset allocation is more important than timing the market. Hybrid funds, in our view, clearly gives diversification across asset classes, and allocation between the asset classes is based on our internal framework, which in turn is based on fundamentals and relative valuations. Rebalancing is on autopilot across cycles, and investors don't have to bother about timing the market. Net-net, hybrid funds give diversification across asset classes, participation in the equity markets, and debt allocations gives downside protection as well as lower volatility. So Balance Advantage Fund within the hybrid funds is a dynamic asset allocation category. The equity allocation is based on a model, and model in turn is based on income based as well as balance sheet factors, and what we call it as the outcome is the composite score. If you look at equity range, it can be between as low as 30% and as high as also 80%. Taxation is equity taxation for this fund. An equity portion is like any other flexi cap fund. That is, we have a freedom in terms of allocating stocks across the market capitalization. However, given the investor profile, we have kept the equity portion large cap bias. At the minimum, we can at least have 60 to 65% large cap. At the current juncture, we have around 76 to 78%. Equity portfolio is built on a bottom-up approach, while obviously keeping the cognizance of the benchmark. Our style is more to buy quality companies up to a reasonable valuation. So if you look at the portfolio, so we have reduced equity percentage in the last month. As I said, the markets have moved up. So to that extent, we have reduced by around 2%, and currently we are at around 53% or so. Our key overweight sectors include private banks, NBFCs, and capital markets, as well as pharma, telecom, aviation. We also have decent weight on the consumption as a theme, X of FMCG, which includes consumer durables, retail, as well as building material. If you look at underweight sectors, they are like cap goods, earlier as I said FMCG and insurance. The recent performance was more driven by pharma, CDMO names, capital markets, and one aviation name. While the performance was impacted by sectors like FMCG and capital goods as well as building materials. If you look at the key changes, so we have reduced some weight on the pharma and banks, but while it's still overweight, and also reduced weight on the real estate side. We added some weight in auto and also some weight in metals. So that was all on the Balance Advantage Fund. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.